Let's talk about one of the most dangerous illusions in business, this idea that growth is always good. We're going to peel back the layers of those flashy headlines and exciting revenue numbers to find the real, disciplined system that separates a flash in the pan from a company built to last.
And we're going to start with a quote from Warren Buffett that should really stop you in your tracks. He's not talking about failing companies here. Nope. He's warning us about a certain kind of successful company. The idea that super fast growth, the thing we're all taught to admire, could actually be the sign of the worst sort of business. Well, that's a heck of a paradox, isn't it? It makes you question everything you thought you knew about success.
So that's the big puzzle we're going to unpack today. How is it possible that a company that looks amazing on the surface, sales are booming, they're grabbing market share, could actually be destroying value underneath it all? The answer? It's all about looking past the performance and into the machinery.
Okay, so let's dive into part one, the allure of the top line. You can think of this as the siren song of growth, that powerful and honestly often dangerous focus on revenue that can pull even the smartest people way off course.
And this really shows you the fundamental conflict. Over on the left, you've got the stuff that makes the headlines: revenue, income, market share. It's exciting, for sure, but it can also be incredibly deceptive. On the right, though, that's the economic reality. Can you generate cash? Are you disciplined with your capital? Can you produce sustainable returns? This is what builds actual wealth. The goal isn't just to make the left column bigger, it's to absolutely master the right one.
So, let's give this problem a name. The problem Buffett was talking about, it's called bad growth. And it's basically growth that acts like a black hole for money. It demands massive amounts of capital, for new factories, more people, huge marketing campaigns. But the returns it spits out on all that invested money are just tiny, or maybe even non-existent. It's all motion, but no real forward progress. It's just burning cash to look busy.
Which, of course, leads us to the antidote for bad growth. In part two, we are all about the gospel of cash, because if accounting profit can sometimes be an illusion, cash is the undeniable, hard reality. It is the real bottom line.
And the metric we're looking for is free cash flow, or FCF. This is the financial oxygen a company breathes. Seriously. Because without it, a company that's reporting huge profits can still suffocate. FCF is the actual, spendable cash you have left over after you've paid all the bills to run and maintain the business. It's what's real. It's the cash you can actually hold in your hand.
And here's the thing about free cash flow. It is brutally honest. You just can't fake it the way you can sometimes fudge accounting profits. So when you see a company reporting these amazing, soaring profits, but their cash flow is flat or even falling, that is a massive, flashing red flag. It's telling you those profits probably aren't as real as they look. The best management teams out there, they live and die by their ability to generate cash, not just some number on an earnings report.
So we look for three big signs of high-quality cash generation. First up, consistency. Can the business pump out cash year after year, no matter what the economy is doing? Second, efficiency. For every dollar in sales, how many cents actually end up as cold, hard cash in the bank? And finally, effectiveness. How much cash is the company squeezing out for every single dollar it has invested in itself? You put those three together, and that's when you can see true financial durability.
Okay, so generating cash is step one. But that leads to the next huge question, which we're going to tackle in part three, the efficiency test. See, it's not just about how much cash you make, it's about how productively you use it. This is where we measure the true horsepower of a company's economic engine.
And the best tool for the job is a metric called Return on Invested Capital, or ROIC. Put simply, ROIC answers one critical question. For every single dollar that investors, and that's everyone, shareholders and lenders, have put into this business, how many cents of profit does it crank out each year? You could say it's the ultimate report card for management.
And now we get to what might be the single most important rule in all of finance. Every company has to pay for the money it uses. It's a mix of debt and equity. Think of it like a hurdle rate the business has to clear just to break even. We call this its cost of capital, or WACC. Now here's the golden rule. A company only creates real value when its return, its ROIC, is higher than that cost. If it costs you 8% to fund your business, you absolutely must be earning more than 8%. Anything less, and you are literally lighting your investors' money on fire.
This really lays it all out. There are only three places a business can be. When your ROIC is less than your cost of capital, you're a value destroyer. Period. When they're equal, you're just treading water. The magic, the place where real wealth is born,
only happens in that third zone, where your returns consistently beat your cost. That's the whole game. And in a truly great company, it looks just like this. Their cost to get money might be, say, 8%, but their business engine is so powerful, so efficient, it generates a return of 18%. That 10% gap in the middle, that's what we call economic profit. It is pure, unadulterated value creation, and it's the source of all durable, long-term shareholder returns.
So, what happens when a company can keep that positive spread going for years, maybe even decades? Well, that tells you something incredibly profound. It tells you they have a real, sustainable competitive advantage, what Buffett famously calls an economic moat, that's protecting them from the competition. It's the financial proof of a truly superior business.
So a great business generates a ton of cash and earns high returns on it. Awesome. But what happens next? This brings us to part 4. The allocators test. This is where the human element really comes into play. What do the managers actually do with all that cash? You could argue this is their single most important job.
So imagine a CEO sitting on a big pile of cash. They basically have 3 fundamental choices. They can reinvest it back into the business to grow organically, they can use it to go out and buy other companies, or they can give it back to the owners of the company, the shareholders, through dividends or buybacks. The entire fate of the company really rests on how wisely they make those choices, year in and year out.
But you see, the great capital allocators, they're just a different breed. They don't just chase the next shiny project, they fund long-term strategies. They have absolutely zero tolerance for that bad growth we talked about earlier. They're obsessed with understanding the real, intrinsic value of their business, and they build these disciplined systems to make sure decisions are based on cold, hard logic, not emotion or ego.
Because at the end of the day, this is a test of pure discipline. The temptation for any leader is to just build a bigger empire, to chase growth for the sake of getting bigger, for the headlines, for the prestige. But the great allocator resists that temptation. They have a single-minded focus on increasing per-share value, not on just building the biggest company on the block.
And that brings us to our final section, where we put all these pieces together. Because you'll see that financial greatness isn't just a series of random lucky events. It's a powerful, self-reinforcing system.
And here's how it all connects into this beautiful, virtuous cycle. It all starts with a superior business model that delivers high returns on capital. Those high returns then generate tons of free cash flow. That cash then enables smart, disciplined allocation, which means putting that money back to work in high-return projects. And that, in turn, keeps the ROIC high, and the whole cycle starts over again, compounding value on top of value over time.
And what this really shows us is that financial greatness isn't a single home run or one lucky product launch. It's a culture. It's a machine. It is a system of discipline, all built on a deep-seated philosophy of creating real long-term value.
So, I'll just leave you with this question. The next time you read a headline about some company's blockbuster quarter or its explosive growth, are you just going to look at the top line? Or will you now know to look a little deeper, to look for the cash flow, for the return on capital, and for the discipline that separates the companies that are just successful for a moment from the ones that are truly great?